Welcome to the On the Tape podcast. I am Danny Moses. We have a packed show today. We have Jim Chanos from Chanos and Company. He's been shorting stocks since 1985. And then on the backside of this, it is Masters Week, quite a golf tournament in Augusta. We have Ned Michaels, broadcaster, former pro himself, coming on to give us his picks. He's on masters.org during the tournament and hosting holes 15 and 16. Without further ado, Jim Chanos, welcome to the On the Tape podcast.
Thanks for having me, Danny.
Well, we planned this before this latest debacle in the markets, but it's amazing when the tide goes out, people actually start doing, obviously, bottom-up work. But I want to start, you're a big history of the markets. When you look up famous short sellers, it's Jesse Livermore and then it's Jim Chanos. Just FYI, I happen to do that. And you've seen a lot in your time, but I know you don't really trade the markets per se, but I would just love to get your thoughts here on what you've seen unfold over the last few days and how you think it resolves itself at all. And then we'll talk about how you would play that.
So first of all, I hope I don't end up like Jesse Livermore, but okay.
I said famous short sellers, not infamous short sellers. All right. Sorry.
Yeah, famous short sellers is a really low bar, though. I mean, as a partner of mine used to quip, it's being called the toughest guy in France. I mean, it's a really, really low bar. In any case, I'm happy to be here. Yeah. So look, markets, I've learned in my 40 years of doing this, in terms of running money, and 45 in terms of researching the short side and running money. Market levels are inherently hard to predict. Predicting the future is very hard. However, we do know that there are periods where the risks are greater and the risks are less. And that when the risks are greater, if something does go wrong, you stand a far better chance of damaging your portfolio on the long side. And for the last year and a half, really, I thought that the risks were they really elevated in terms of valuations, speculation. We had kind of a reprise of what we saw in 2021, which was the most speculative market I've seen in my career. And by post-election 2024, January 2025, we're starting to see the same type of behavior. Stocks going parabolic, mass speculation in crypto, a belief that the politics was now solved to the upside, and all you needed was a pin to find the balloon, and the pin showed up kind of as advertised. Quite frankly, I mean the whole idea of upending the economic or the framework we've had since World War II and putting in tariffs and other controls is something that Trump ran on. And I think that because it didn't happen at great length in the first Trump administration, people just thought, oh, well, he'll be controlled by people who will tell him this is crazy. And in fact, we know that didn't happen.
We're going to get into single stocks and how you think about shorting stocks and what makes you do that. But let me ask you a question, because beyond all this, kind of the fabric of the U.S. is certainly being tested, us as a trusted partner. But within all of that, in order to really short a stock and feel like you'll be vindicated and validated, you need securities laws in place to make sure that what you're seeing gets enforced. And so just with the small changes we're already seeing at the SEC, probably not as small as we think, probably bigger, and the DOJ, you were great at identifying fraud, and we're going to go down history lane here in a few minutes. But give me your thoughts now as a short seller that's in the market, since there's literally like 10 of us left at this point. How you would change the way that you approach it, given that you now have to factor something technical in versus fundamental.
Yeah, so this has been building for a long, long time, as you know. I mean, I think I first dubbed it the golden age of fraud back in 2020. And it's only gotten worse. And now with the latest administrative moves by the Trump administration, for example, to put the SEC in effect under the White House, which I don't think got the press it should have, the movement to disband just today the DOJ's crypto fraud unit, the willingness to pardon people like Trevor Milton, I think just keep sending signals to the marketplace that there's no cops on the beat. And what few there were a few years ago are even less today. And that's terrifying to me as a market historian, because the fraud cycle follows the financial cycle with a lag. And it's been bubbling now for a better part of 5 years.
And this is happening now at a time where things were already slowing before the tariffs came in. We were starting to see companies get a little bit exposed. And you're right. I saw that obviously a couple of weeks ago, that literally the White House has to approve any investigation of a company or a person by the SEC before it can move forward. So, again, that's a challenge that we'll have to look at. So you say that, but it would change the way that you are approaching that. If your story was reliant upon the government exposing something, would it change it, or are you saying the time frame might change?
No, I long ago said that financial regulators and law enforcement are archaeologists, and short sellers and financial journalists are financial detectives. They're incentivized to look for this stuff in real time. The SEC and others will tell you with great clarity what happened at Nikola Motors or Enron or what have you, well after you've lost most of your capital. And so, again, we've never counted on the SEC or anybody in terms of deus ex machina of helping our short position beyond just the fundamentals of the company itself.
So you and I met about 10 years ago. I've been following you for years and always looked up to you, the way that you approached the business, and you really did the work, and everyone knows what you did with Enron and then Wirecard, obviously a few years ago. But the story that we linked up on at the time, we don't have to spend a ton of time on it, but it was the Tesla acquisition of Solar City. And it was mind-blowing at the time, not just the valuation that they were paying for, but the reason behind it. We all know he was getting margin called Elon Musk, and he obviously acquired the company. Obviously the case has already been heard that there'd be no penalties associated with it because everybody made money because it was the best thing that could happen to a Solar City shareholder at the time. That's where we linked up. And I think it is amazing that it's been 9 years almost since that time period goes by, and we're still dealing with this entity. And again, I think people mistake emotion and you do a great job of separating emotion from just looking at numbers, looking at accounting, looking at valuations, looking at things. But give me your latest talk. Are you still involved in Tesla? And I'll give you my honest answer. I just have a put spread on. I'm not going out and shorting the stock. It's because it doesn't trade on fundamentals. But is this something you're currently involved in?
So I just want to be clear. We advise clients right now. We're not running any third-party funds or other than our own money. So, but we're still telling clients that they should be short Tesla, and personally, we have positions as well. Look, the Solar City deal was the first huge tell back in 2015. Solar City was going bankrupt, and we were short Solar City, and it clearly was having problems. Musk came in to as an affiliate shareholder and bought the company and put it out of its misery. But you're right. I believe it was the judge in the opinion talked about the stock price, and we're really, really in kind of uncharted waters right there, because I've always said that stock price is the greatest prosecutor as well as the most staunch defense attorney, right? And I teach this in my class as part of the fraud cycle. People really don't get upset about this stuff until they start losing money. And typically when retail starts losing money, they will say, it wasn't my fault. I bought Enron at $80. They were crooks, right? And then project that on all kinds of other situations. It'll be the same this cycle, I suspect. And who knows what Nikola would have gotten away with in terms of if the stock had just kept going up rather than collapsing. So it's something that your viewers and listeners should really understand, is that the politics plays a big role in the fraud cycle, and putting pressure on Congress and the SEC and the administration when people have lost a lot of money will move them to action. When everybody is making money, nobody wants to upset the apple cart.
Fair enough. But I would say that you have an administration that creates meme coins and all that, so it's hard for me to see. But I want to talk about just the idea of short selling. Well, I think we're under the same philosophy that you're almost like a detective and you want to root this out. And people vilify short sellers because they think they're anti-capitalist. It's actually the opposite. So I think when you approach it, just give me an idea of how you come up with an idea, how you execute. Oh, I know how you execute it in the borrow, but in the not just the price discovery, but the discovery, forensic discovery, I should say, as you do it, because I'm not saying it's exciting, but it is illuminating when you realize that you have found something potentially that no one else has. And, prior to the internet and prior to information being shared so freely, it was almost a huge advantage because you were probably looking at something that no one else was. Give me an idea of how you approach it.
Well, yeah, you're right. It has changed in an era where all the information of the world that's knowable is in your pocket. It's a little bit different now in that you have to have a variant perception on what anybody can look at, and so it really that's tougher, but it's there. Whether it's things like massive use of fear-based comp to add back to earnings. Whether it's companies playing quite legal accounting games that bolster what it looks like. This is not, in today's day and age, it's not uncovered or undiscovered. However, there are all kinds of new factors in the marketplace, algorithmic traders, pod shops, passive investors, and then, of course, retail investors that sometimes just ignore all this stuff. And they don't face it until they absolutely have to. Wirecard, which you mentioned earlier, is a wonderful example. Wirecard was trading at almost 100 euros the day before it acknowledged that the money wasn't there, on its way to zero. And there were numerous signposts along the way, including a document dump by the FT 9 months earlier in October of 19, that if you had read, would simply prove the fraud. And yet the company, because the company didn't acknowledge it, the stock continued to trade at just a huge valuation for weeks and months afterwards. And so you do get this cognitive dissonance, particularly on the short side, where the skeptics and bears will point something out. But as long as the company has a plausible explanation in a bull market, people will generally, believe it.
Correct me if I'm wrong, but the German government basically was accusing short sellers and journalists of fraud or spreading false information, correct?
Yes, that's true. However, as facts have come to light, I have a theory about that in fact, they knew that the number 2 at Wirecard was a Russian agent, and were actually upset that short sellers and journalists were going to upset this because they were using him to track the money. And in effect, unbeknownst to him, in effect, protecting him.
Nothing like espionage involved in short selling at the same time.
Yeah, it was the last minute twist of the story that I don't think any of us kind of realized.
So you teach a fraud class at Yale this semester, and then you teach at Wisconsin Business School, I believe. So I'm a student in your class. I'm sitting in your class. What's the first lesson? What's the first thing you're telling your students?
Pay attention, Mr. Moses.
Right. What am I reading? What have you assigned me? What case review am I working on at this point?
Well, the first thing is we teach, we do teach a systematic set of models. There's 5 of them that kind of I've determined with a lot of good help from people are really good at not only describing fraud but also predicting it. And then we layer on top of that a historical narrative that starts in the 1680s in the first new issue bubble in London that had a lot of fraud attached to it. And then go right through the Mississippi scheme, the South Sea bubble, the railroad frauds of the 19th century. We just this week did Charles Ponzi and Ivar Kruger in the 1920s, and next week we'll be at the junk bond era SNL crisis and Mike Milken, and then we get onto the .com and beyond global financial crisis. So there's a historical set of cases. But the idea is there is some rigor behind actually thinking about corporate fraud at the highest level. And what's amazing is how similar a lot of them are centuries apart. The tools get a little different, the techniques get different, the markets get a little bit different. But boy, I mean, the human behavior is pretty constant.
So Jim, some of the best short sellers spent time on the sell side at a brokerage company and then made their way to the buy side. And I think it gives you a great vantage point when you see how research analysts approach covering a company with kid gloves, how investment banking don't want the analysts to mess anything up so they can generate fees over time. And I think you discovered that process early on in the 80s with Baldwin and I think a few other companies, but maybe tell some of those stories that helped prep you for your career.
Yeah, I mean, so the reason I got into this was the very first major company I followed was a company named Baldwin United, which it was the old Baldwin Piano Company. And it was run by a very charismatic guy, CEO, who had morphed the company into financial services They bought S&H Green Stamps and MGIC Insurance. But my favorite story was that he got his start at the company by selling pianos door to door. Now, do you know how hard that must be? What a good salesman you must be to sell something that you don't have door to door. Anyway, it was a myriad and mess of accounting because he was using insurance company assets to buy whole companies and revaluing them upwards and using that as capital. And I mean, it was a huge bull bear struggle. But just to give you my sense of timing, Danny, I put my first sell short recommendation out on the company on August 17th, 1982. And if you know your market history, you will know that was the absolute bottom of the 60s to 80s, early 80s bear market. Henry Kaufman, I think, came out that afternoon and said buy everything, and the intergalactic bull market was on. So the stock doubled on us, and it was insolvent the entire time. And then finally, the state of Arkansas realized what we realized and went in and seized the insurance subsidiaries on Christmas Eve in 1982, and the company collapsed. It was the largest financial services bankruptcy in U.S. history up until that time.
Amazing. You're well known, obviously, for many things, but Enron is probably what you're most associated with, of having called that early. And it was an amazing time period, right? Because the dot-com bubble had imploded, obviously, and companies were still functioning. And then obviously the tragedy of 9/11 also was another moment to reflect. And then really the companies that had been underperforming were exposed. Give me that process there on Enron. And obviously, you were obviously noted, you've been in a couple movies, but I wanted to say you were in the original Wall Street movie as yourself. So you have one up on me since I was only portrayed in the movie. But give me your Enron story there.
Well, so I always quipped that Enron was actually one of the largest shorts we're well known for, and was also one of the easiest. We basically got involved in late 2000 after a friend sent me a Heard on the Street column written by the great John Weil, who actually came to work for me later, and I think it's back at the Wall Street Journal now. And his forte is accounting, and he pointed out that the energy merchant banks like Enron had gotten a favorable ruling from the SEC on their mark-to-market accounting. Now, it's really mark-to-model accounting. Mark-to-market is actually A-OK. Mark-to-model is when you get into trouble. Anyway, and so we began to look at it and put a position on 6 weeks later, I think, in November of 2000. Bethany McLean was talking to my partner at the time, Doug Millett, coming into the new year. Are you guys doing anything? And Doug said, you really got to look at this Enron. And we spoke to her about it, walked her through the story, and she wrote her story a couple of weeks later, and the snowball started going down the hill. But it was interesting because in Enron's case, hiding in plain sight, everything but one important fact was kind of there in their documents, in the footnotes. The fact that they had these offshore entities, that the senior executive of Enron, who we now know was the CFO, Fastow, was doing business with Enron, and that was an immediate red flag for me. Like, wait a minute, how can you be selling and buying assets with a third party, partnerships where the senior executive of Enron is also the general partner of the funds? How do you handle that conflict of interest, right? What we didn't know, and what was the final nail in the coffin in October of 2001, was that there were the secret make good agreements whereby the investors in these funds were promised that if they lost money on the various trades with the parent, that Enron would issue them stock to make good. And that was not disclosed. And it's actually one of the reasons why Skilling resigned in August of 2001, we think. But, by short selling standards, I think we started shorting it at 60. It went to 80 something, and then pretty much went straight down. That's not our usual history on the short side. So it was relatively contained. Of course, you had 9/11. You had the trading in the California power markets, which also tripped them up, and so on and so forth. So it was interesting, but the other tip off fundamentally was their obscenely low return on capital. So even if you gave them all of their accounting, and that was generous, their return on capital was about 6% pre-tax. and people were paying, 10 times book value for that. And it was like, and this is an energy hedge fund where you're earning 6% and you're paying, 10x NAV for the opportunity. It made no sense, even on just a traditional earnings analysis before you even got to the fraud.
I'm glad you mentioned Bethany McLean. She's actually going to be coming on the tape here in a few weeks. And it's amazing the role of journalists. And there's not many of them left that really do that type of, investigative journalism out there, but it is extremely valuable. So something to certainly pay attention to. Okay. I want to just try to help the retail investor understand what they should be looking for in names. I think, heavy short interest. Yes, people think it can be bullish at times because that means that there's built up demand, but it should be a red flag to people if it's done not against a debt that they're hedging out or something like that, but purely betting against the companies. What are the things that you would look for or red flags as a retail investor before, investing in a name that might be deemed to be controversial?
Well, again, a misperception by retail of what the company is versus what it really is. And I just point out regarding heavy short interest stocks, I mean, some of the most rigorous academic work on factors will tell you since the 80s was the first study I saw, was that stocks that are on the most shorted list or factor historically over the long run have massively underperformed the market. So short sellers are generally informed traders. Now, short term, it adds to the volatility, as we saw obviously during the GameStop episode, and every time the market sort of picks up heavy short interest stocks rally harder. But over the long run, it's a very bad bet to say that the short sellers don't know what they're doing. Number one. Number two, we want to see again, when there's a narrative about a stock that is just completely, nonsense, yet the company kind of plays along because they love what it's doing to their valuation. That's something we're interested in. There's a lot of those situations right now where people are claiming, XYZ is an AI play or what have you. And in fact, we saw that in the late 90s as well. What everybody forgets about the dot-com era and its aftermath is that the internet, which was a phenomenally, major technological invention and breakthrough, destroyed as many businesses as it helped create. And so we're also looking right now at that as to where AI in its deflationary, sort of way will impact business models. But there's a number of situations that are just sort of silly out there, where retail has taken them to the moon on a belief that the company is something it's not. I mean, consider my old friend IBM, which until a month or two ago was hitting kind of new interim highs and was trading at really elevated levels compared to historical where it's traded. And people just basically say, oh, well, it's going to benefit from AI and it's a quantum computing company. And meanwhile, people kind of don't realize is that IBM is really more of a consulting company and marketing company. It's not cutting edge technology. The margins don't tell you that. And the business doesn't tell you that. And on top of that, they've been playing sort of pro forma earnings games for, probably as long as I've been alive. And so IBM, people believe IBM's making $10 or $11 in earnings. We have a metric that actually just looks at their operating earnings, plus or minus their interest expense, plus their royalty income, tax it at 21%. And that number is like $6.50 with the stock at 230. So it's just, and not growing, down over the past 5 years and 10 years. Revenue growth is de minimis, and the free cash flow story that the bulls like to pull out is also misleading because IBM has been averaging $4 or $5 billion of acquisitions every year and not growing. So those acquisitions are the same as CapEx or capitalized R&D. And so the real free cash flow is sort of similar to our operating earnings number of about $5, $6, $7 and not growing. So, that's a good example of where the perception hiding in plain sight is taken over, and people are kind of fooling themselves to think IBM is some cutting edge technology company. It trades at multiples now, I think, in excess of some of the Mag 7.
And also, when you talk, let's move from IBM to the data centers, which I know have worked out here recently, I believe, and maybe talk about that. And is that something that you're still advising on or still involved in?
Yeah, we're still advising. I quipped it's one of the worst business models I've ever seen. And by data centers, we're talking about the legacy data centers, the old ones, not the ones the hyperscalers are building right now for tens of billions of dollars, but the old ones that are basically we're servicing the cloud for not only businesses but the hyperscalers as well. And that business is basically a disaster from a return on capital business. But the two big players are in REIT format, and so therefore people analyze them as REITs, even though unlike warehouses or even office buildings, the capex at data centers is enormous. Before you even build a new one, just the maintenance capex is enormous. You look at the cash flow statements of these companies, and they're basically now issuing stock to pay dividends, and trade at just towering multiples. Again, they trade at higher multiples than the hyperscalers themselves, and yet have returns on capital that are, low single to mid single digits below their cost of capital. So it's a head scratcher. The stocks all rallied in 23 and 24 on AI, but I think reality is starting to set in now on the group, and they've come off pretty hard the last month.
Which are the two that you're referring to, just for the
Digital Realty, DLR, and Equinix, EQIX are the two big ones.
Got it. And then probably the most volatile of them all have been the solar stocks, obviously. And
I mean, that's an area, that's an area that we've been, since Solar City, that have been harping on. It's just, this is a good example of varied perception. I mean, these stocks traded on this Rube Goldberg kind of contraption of net present value added every quarter. And we just looked at this. Yeah, but you burned $500 million in cash. You can talk about NPV all you want, but if you just keep burning $500 million in cash and having to raise it in the marketplace, either through securitized lending or selling equity, you don't really have a great business. And the stocks, of course, rallied with solar incentives under Biden, but it didn't change the business model that much, that they were just burning cash to put these solar panels on people's roofs. And now we're starting to see bankruptcies. We're starting to see some private companies went bankrupt last year. Sonova, which we were short, is, I think, below $1 now, and is talking about possibly hiring restructuring advisors. And I don't think Sunrun avoids it. I think they're all going to basically end up in restructurings or in actual bankruptcy.
it is amazing. I'll just share a name that I've talked about in the past, that Upstart, which is a financial company, specialty finance company with $6 book value, that was trading at one point earlier this year at $85 or $90 a share. What amazed me about it is, and listen, the analysts that cover it are technology analysts, and that's whatever. Wall Street's going to do what it's going to do. I could not believe that they didn't raise capital. And it's almost as if they don't want people to know that it could be a capital intense story. And when you see credit spreads blow out, which I want to end on here in a second, credit spreads blow out, it has an impact on them. And if you're holding it as an investor and a retail investor, you're like, I don't understand what's the impact here, and these companies should be raising capital. And you mentioned some do and some don't, but it's almost like when they do, they don't want to ruin the momentum of being perceived as something else that doesn't need capital. And so it always amazes me. The great CEOs will take advantage that knowingly think that they need capital and take advantage of those stock prices and live to fight another day. But it's amazing how many of these companies don't give themselves that ability.
A very, very famous investor who taught me in the 80s when I was doing my work on real estate in Texas and savings and loans and commercial banks before the crisis. And I was worried about the rapid growth of loans at the Texas S&Ls and some of the other ones. And he said, Jim, he said, those are exactly the financial services companies you should be looking at. There's no governor, for the most part, as long as you have enough of a capital base, on growth in financial services. There's always a bad credit that will take your money.
That's exactly right. You and I were texting the other day when everyone was cheering bond yields, at least at the time, going down, treasuries, before they've kind of reversed course here, and no one was paying attention. I'm not saying no one, but the people weren't paying attention to credit spreads, which have been widening. And I would almost use the phrase blowing out. And I think it's really important that people understand how financialized the economy is, how dependent on selling these securitized products some of these companies are to function, not necessarily all the ones we've mentioned today per se, but how that's, I think, in stock picking world, it's one thing to short stocks, and in credit world, I think people need to pay attention. What are your thoughts here? Because appears that they're going to be more affected by the economy here.
It was one of the, I think I tweeted out, it was one of the missing elements that just showed up. And yeah, so we watch credit spreads as you do. And because our world is kind of affected by them, we for the most part are not shorting, blue chip type companies. And if you have a market at 20 sometimes earnings, and the triple B junk yields are 5% or 5.5% or 6%, that's one thing. When they're 8 or 9, it's a completely different thing. And that's where they've gone all of a sudden in a matter of, a week and a half. And I don't think enough people are paying attention here to the fact that spreads have blown out rather dramatically. And so it affects the financial service guys, but it affects all kinds of companies, as you said, because of financialization of the economy. So we do pay attention to it. And I think it's kind of been one of those things, given all the gyrations of the last week, one of the things that's got lost in their shuffle.
One of the other anecdotes as a short seller, and I'd love to get your thoughts and maybe give me one example, is we used to find that if we were short a stock, we would want to meet with the management team, and the management team might know we're short, might not. But the best management teams would always have the meeting. And it always told us that, great, let's listen to the other side. The ones that wouldn't take the meeting, we actually felt we would get more entrenched because what are they necessarily hiding? Can you give me an example of when you were shorting a stock, you had a thesis, you actually met with the management team, and you felt that you actually might have been wrong on this, you misunderstood their strategy or how they were accounting for something?
Very early in my career, I was looking at FedEx back in, this is 1984, 85. And Fred Smith actually invited me to come down to Memphis. And I came down and met with him and the CFO and the IR person. They walked me through their warehouse at night, but they had some really interesting insights on their accounting. It was an accounting story at the time, on depreciation, a lot of other things at CapEx. And they did a very good job of explaining that the CapEx that was going in that I was concerned about was actually very productive. And they showed me why. This was before Reg FD, by the way. And what the incremental return on capital was. And I came back and said, you know what? I think that's a pretty persuasive argument. And we didn't write it up. But the flip side is, I'll give a little bit twist on your comment. I think probably one of the reasons I've made the most money in my career is by not meeting with management, because really good financial sociopaths believe their own bullshit and will lie with impunity, and you will believe it as a human being for the most part. If they have a glib explanation for something that you realize later didn't make any sense, you'll just go, okay, well, that seems okay. I'm thinking of people like Jeff Skilling and others who just basically, were able to talk their way through a lot of things that turned out not to be true. And so I'd much rather look at the financial statements. And if I need a question answered, we know everybody on the sell side, we can always get a question answered. This day and age is just not hard. If you have an accounting question, to at least get the party line on something. But yeah, it's amazing how many CEOs and CFOs will look across the table from you and just say, oh, well, it's not a problem. Here's why.
Well, listen, these are great perspectives. And, Jim, you're a student of the markets, you're a professor in the markets. And I think understanding the history, and I'm a big fan of reading all the nonfiction history because it always rhymes. Every crisis, every product, it always rhymes. And to be aware of it only makes people smarter, and we can protect them from themselves. And I really believe that short selling is an important part of capitalism in terms of exposing. And listen, you can be wrong, you can be right, but it's always a timing issue. You're always going to be early when you're short. But I think we're going to have a lot to talk about here. Just if we have a normal economic cycle, forget about the tariffs and all the noise for a second, that a lot here. And I think that this is valuable and people should really start to dig deeper. Thanks for coming on the tape, Jim, with us today.
My pleasure, Danny. Take care.
We are back on the Tape podcast with Ned Michaels, live from Augusta. Ned was a former professional golfer, and he won on the Asian Tour, competed on the European Tour. He's been broadcasting for over 10 years. He actually is the American voice for BBC, and he's going to be on holes 15 and 16 for the Masters this week. That side story, Ned and I actually were teammates in the CME, the first CME Pro-Am that we won a few years ago together. Even with your bad back, you could smack that ball. It's really unbelievable. And I actually, if I remember correctly, you're good friends with Brent Snedeker from your days in Nashville. And let me just say this background that I have today. I'm actually in your hometown of Nashville, and I will be coming to you to Augusta. So, Ned, welcome to On the Tape.
Happy to be here, and I hope Nashville's treating you well, man. Probably a short trip, but I hope you're getting some good barbecue and the hospitality's what it's supposed to be.
Yeah, it's amazing. When you get into the Nashville airport and there's live music playing in the airport bars, that kind of welcomes you to the city. So that's pretty extraordinary. So you and I have talked over the years. You're amazing in terms of how you analyze these golfers, and it's not just the physical aspect, but you pick up on the kind of the psychological stuff that these players are kind of going through. And when I say psychological, it may just be struggling with changing swing coaches and all those things. Golf has become so popular, so polarizing over the last few years between LIV and the PGA. But you have kept your head down and done a tremendous job. And I love listening to you. And obviously, when I'm not there on Thursday, I'll be listening to you Friday, Saturday, and Sunday on 15 and 16. Give me your early analysis of what we should be looking for here. And we're going to get into some picks. Give me a general overview for how you think this course is going to play.
Okay, general overview is yesterday we got quite a bit of rain. It was kind of a washout all afternoon. So the golf course is a little bit softer. It's going to be beautiful, as you can tell. A little sunburn. I was out today walking the golf course, and it's going to be beautiful. I think Thursday is going to be a little soft and a little chilly. And then as we get some breezes, supposed to gust into 20 miles an hour, we're going to start to see Friday firm up. And it's going to be chilly over the weekend. So I think when you look at the conditions of the golf course, the scores could possibly be pretty good on Thursday and Friday. Maybe some rain on Friday, but if it doesn't, the score is good Thursday, Friday, and then it could be really difficult. You get gusty winds around this place and cold temperatures. I mean, you gotta have all kinds of elements into the equation, trying to figure out how far you're hitting the ball, gauging the winds, elevation change. The weekend could be really tough, but fun to watch for us.
Yeah, for people out there, I think most people know this, but Augusta hosts the Masters. It's the only place where the tournament's the same place every year as far as the four majors goes. The other ones rotate through. And it's interesting, this was the breaking the barrier of allowing, over the last few years, LIV golfers to come back and play in the majors. So I'd like to start with kind of the LIV golfers that we think that could compete. Bryson DeChambeau, obviously, probably being at the top of the list, considering he's maintained form. Give me an idea how you think those guys will do this week.
Yeah, listen, I think Bryson's he's got the tools to win around here, no doubt. I don't know what we're going to see because he hasn't played that much. He only played 4 times this year. He's only played one 72-hole event. That was in India, in the last however long. It's been a minute, to put it that way. So I actually think he can play pretty well. His putting is going to be what determines how he plays. And then I'm looking at Sergio Garcia has been playing great. 3 runner-up, couple of wins in the last year and a half. And Phil Mickelson, he had a good run last week, and he's kind of finding some form. I'm not saying he's going to win, but it'll be interesting to watch Phil. And then John Rahm. Of course, he's a champion here, so he knows the golf course. The Spanish history here is rich. So I think those, for me, the 12 players from LIV Tour who are playing here this week, I think those are the guys. And if I had to rank them, I would probably say Rahm, and then Bryson, and then Sergio. You can throw Cam Smith in there. Cam Smith has an unbelievable record around here. And even when he's not playing well and he comes here, he still plays well. So, and Joaquin Niemann is probably the highest profile of the LIV guys. His record in the majors, not great. And he needs to show me something before I'm willing to put, my name by it in a pick for potentially contending to win here.
All the odds makers are favoring Scotty Scheffler. I watched an interview with him. He looks extremely focused. I know he always is, but to me, he looked focused. Rory McIlroy, who will probably be, I would think, the crowd favorite. They're going to want him to get this one to complete the career Grand Slam. And then you have the Xanders and everything. Give me an idea here. Obviously, the favorites are chalk. I mean, these odds aren't great to take a Scheffler or a McIlroy per se. But give me your thoughts on kind of those top 3 or 4 golfers in the world, and let's go into some long shots. Maybe.
Okay, listen, Scotty Scheffler, I don't know how you bet against him. He hasn't won this year. That's the only knock that you have on Scotty. A couple weeks ago in Houston, he played beautifully. He tied the course record in one of the rounds. Yeah, he didn't win, but he was right there. He had a chance. He pushed to the very end. He seems to be ready to win. It's got to be eating him up that he hasn't won. Last year, in his 6th event on the PGA Tour, he was playing in Orlando at Arnold Palmer's tournament. He won that event and then went on a tear. This will be the 7th event for Scotty Scheffler of the year. So the timing's right. I think the hand issue, the injury over Christmas, I think is now behind him. He's got his feels. I saw him today practicing. He was actually practicing pitch shots out of the pine straw. Now, you don't see a player who's struggling with his game doing that, right? You see guys struggling with his game, hitting a bunch of balls on the range, looking at the track, man, has his coach out there. Scotty Scheffler's practicing pitch shots out of the pine straw at the practice area, okay? So I feel pretty good about Scotty Scheffler. Again, the odds are your thing. I'm just telling you what I'm seeing in picking players. Scotty Scheffler's got to be at the top of the list. Rory McIlroy, he looks the part. Like everything is there for Rory. It's just a matter of, okay, can he get past the first round? If you look over the past 5, 6, 7 years, he hasn't gotten off to a great start here. He hasn't shot in the 60s except for once and maybe the last 7 times. So he's a good round on Thursday, but all the tools are there. His swing is where he wants it to be. He's spending a little more time with Bob Rotella, the sports psychologist.
Oh boy,
So
that's not a good sign, Ned, is it?
no, I think it's a great sign.
Okay.
And you look through. Rotella has this amazing gift to Darren Clark before he won the Open Championship. Spent time with Bob Rotella, and these are guys who work with Bob anyway, Dr. Rotella, and so Rory works with him anyway. So this isn't something new. And they've put a plan together over the last couple of years and seasons that he's come here. And it's not just how I'm playing the golf course. It's what am I doing off the golf course? How am I spending my time? How am I conserving my energy? So I think it's chalk. But guess what? So is the NCAA basketball tournament, right? So, yeah, I think those are your 2 guys, and then you can start picking from the rest of the field. But give me those 2 guys versus the rest of the field, and I'm almost I might just take it.
Yeah, right now Scotty's 4-1 and McIlroy is 6.5-1 as I look at the odds. Morikawa is an interesting one. I know you've been tracking him this year. You think he obviously is playing very well. This course should set up well for him, no?
Yeah, and he has let me just pull out some notes. He's got a good track record here. Again, for Morikawa, it's going to be how is he putting? Is he seeing the lines well? And I just think looking at him, I had him a couple of featured groups earlier in the year. He's hitting the ball as well as he ever has. If we get soft conditions Friday and cold, I mean, he's not the longest hitter in the world. That could be an issue, but it's going to come down for him to, does he make enough of those putts from 6 to 8 feet? And he's shown me enough this year that, yeah, I think he's probably out of my picks, maybe 5th, but he should be on your short list if you can get good odds on him.
And another guy, Oberg, that won a tournament a few months ago, or I don't know how long it's been, and then just hasn't seemed to have found his groove after that. What are your thoughts on him? Because he's still high up here. I'm looking at him, he's 18-1. And is he in form or has he lost his mojo a little bit here?
Yeah, I saw him at the Players Championship, and I saw him the week, I guess 2 weeks before we had him in one of our featured groups. There's something off with his golf swing, and I watched him hit balls today. Again, it looked great, but he looked to me like he was coming in a little bit steep, kind of again, I'm splitting hairs. We're talking about one of the best hitters of the golf balls on the planet, but it kind of crept into his putting as well, a little bit outside in and a little pulley, and that's not the kind of thing that you fix in a week's time. So despite finishing second on debut here, I'm shorting Oberg, which may be risky, and I may look foolish at the end of the week, but he's not on my short. I should say, but he's not at the top of my list. He's on my fade list.
I got to tell you, I love Shane Lowry at 30-1. I think he's playing well. Tee to green, he ranks near the top, I think, in terms of strokes gained, if I'm not mistaken. On the tour, I think he's a top 10. I know that's a big factor coming in. How's he looking? And then I want to talk about Spieth, the enigma. Drives me crazy. And I hate betting on him because I feel his emotion. It makes me crazy, and I'm emotional on the golf course. Give me your thought on those 2 guys.
Yeah, your emotion's good emotion, though. Well, I guess we won, so
I like to use it in a positive way. I won it again this last year, but I didn't contribute as much, but I contribute to the team, to the camaraderie of the team. But yes.
I think, your putter is your strength. And so if we look at Shane Lowry, putter used to be a strength. Now it runs hot or cold. It's very hit or miss. And when he gets going with the putter, he can really fill it up. But his ball striking, to your point, has been terrific this year. He's had a good season. He's already got 4 top 11 finishes. He's better every year, tee to green. He's found a driver that he likes in terms of how the head and the shaft. I won't go too deep, but and that's huge for Shane Lowry because he takes a lot of confidence out of how he's driving the ball. It allows him to be a little bit more aggressive with the rest of his game. Top 25, 4 of his last 5 Masters. And from what I've seen from Shane Lowry this year, I like him. Now, he has to play the 15th hole better. The 15th hole, especially if the hole location is on the right side of the 15th, has gotten him a couple of years in the past 5 years here at the Masters, where he ends up making a big number and it takes him completely out of it. So it's just something to watch out for. But as we start the week, Shane Lowry has to be on your short list.
And comments on Spieth. I mean, I'm going to take it just because I can't not be there if somehow he puts 4 days together, but he just seems he's still injured. It doesn't seem right to me. What do you think?
And I will take the complete opposite side of that.
Okay.
I am thinking Jordan Spieth could surprise a lot of people right here. A couple of top 10s already on the season, and he's driving the ball better than I've seen him drive the ball in at least 3 seasons. Much more straight. And I'll look at last week where fairways are really hard to find in San Antonio, tough windy conditions, and he showed me enough. But the main thing he showed me is putting like Jordan Spieth again. You get Jordan Spieth on this golf course with big breaks and undulations. He says that his mind responds better to that, where you have to be more of an artist instead of a linear thinker, like a straight line thinker. So I actually think Jordan Spieth's going to surprise some people.
I like that pick. All right. So he's in his happy place there for sure. Another name that he's been playing great. He's like the Rodney Dangerfield of the tour. Russell Henley. I mean, he's 40-1, and maybe I like him more for a top 10 than to win, but have you seen him out there? Did you see him today by chance?
Yeah, so on the day, he's very efficient, and that's what I'm looking for. I'm looking for players as we're getting ready for the event. Now, again, they didn't get a ton of practice in yesterday because of the weather, but when you're looking and watching them on the range, I'm looking for guys who are efficient, who aren't working with their coach, spending a lot of time on the TrackMan and trying to find their golf swing. If you get good odds on Russell Henley, like mash the button. And I'm not saying that he's going to win the tournament, but if you can get a top 10 good odd or something along those lines on Russell Henley, yeah. He won at Palmer's Place in Orlando, a very tough, difficult golf course. His ball striking is become elite. And you also look at players in groups. So this is a Ryder Cup year. Look who's won on the PGA Tour. A bunch of Europeans have won. I think there have been 9 international winners already or something like that. You look last year, it was a President's Cup year. Canadians played well, right? Because the President's Cup was in Canada. You look at this cohort that Russell Henley is part of. He's part of the Georgia Bulldog clan, right? He went to the University of Georgia. Well, guess who won last week? Brian Harmon. Guess who recently won the Open Championship? Brian Harmon. Guess who won in the desert of California? Sepp Straka. He's a Georgia Bulldog. Harris English has won this year. These things, they tend to come in patterns. And so, yeah, I mean, not only if you want to take the mystical stars, Russell Henley's a good pick.
All right, we glossed over Xander Schauffele. We glossed over Justin Thomas, only because I don't think those guys can put it together. Tell me I'm wrong, or pass on these guys, or how you feeling about them?
Hard one for me to predict on Xander. Yeah, he has the pedigree. Won 2 majors last year. A great ball hitter. Has a good record around here. Had a chance to win the year that Hideki won. You know, hit it in the water on 16 on Sunday, and that was it for Xander. So it's a hard one to pick though because he's been injured. So I will take the pass line on Xander, and I think JT has a really good chance. From what I've seen from JT this year, it seems a little more motivated, seems a little more calm, a little more grounded. He's not trying all these different shots. He only hits them when he needs them. I like what I see out of Justin Thomas.
All right. My favorite player, literally, I think I just love the guy, and not just because he's left-handed, but Bobby Mack. I mean, Robert Mack. Something about him. It feels like he's built for and he's being looked over. I think his current odds are 60-1. How's he swinging it? Have you seen him?
Yeah. 60-1. Bye.
Okay.
Yeah. He played well here last year. Lefties, as we know, for whatever reason, I won't go.
I'm one of them, obviously. I've yet to win Augusta. I've yet to win there, but this is, yeah. we won't go through my famous Mike Weir story, but yes, we've seen Mickelson and Weir.
Of late, Bubba Watson.
Bubba Watson won it twice. Yeah.
Correct. So, and for Bobby Mack, he's become a world-class hitter of the golf ball. But more importantly, you go back to the Ryder Cup in Rome. He was not playing well going in. He started off poorly. Justin Rose took him under his wing. And that has given Bobby so much confidence. And now he won in Scotland last year. He won Canada. He's won some very big events. And when you're home open, that is so big. That's so much pressure. He has the mentality for it. He loves this place. Of course, it has Scottish roots in a lot of ways. So Bobby Mack, to me, you can get 60-1. That's a no-brainer.
All right. Bye. All right. Any other names that I've glossed over that are sticking out to you?
In terms of just the odds of things, there are all these weird anomalies of to players win the Masters, average age 32. It used to be the world ranking was 12th. Obviously, the world rankings have changed a little bit. But there are all these kind of interesting historical parallels of players who win. Sepp Straka. Now, I don't know if he's going to win, but if you look at, you need to play the par 5 as well. You need to play the par 3 as well. And you need to be at the top of 3-putt avoidance. These are some really kind of integrated stats. But if you go through these kind of top 5 stat levels, the only player that checks all the boxes is Sepp Straka this season. I don't know that he wins, but statistically speaking, Sepp Straka you got to pick because I think his odds are pretty good in terms of you can get some good odds on it. Tony Finau is a guy that I don't think anybody's looking at. And I love what I've seen out of his ball striking the last 2 weeks. Had him in our featured group. He's moving the ball left and right comfortably. He's changing elevation, no problem. Yeah, is he a balky putter at times? Yeah, at times he is. But he has a terrific track record here. And the main reason I like him, he played with Tiger the final round when Tiger won just a couple of years ago, right? He played with Tiger. John Rahm also had a similar experience playing with Tiger, final round. Tony Finau knows the blueprint, and he knows it from a pressure standpoint, knows how to handle it. He knows how to play. So if he gets himself in contention, I can see Tony Finau slipping in the green jacket. And he's a name that not many people, I think, are really high on.
You're right. I was looking at his odds. I think he is over 60-1. You're right. Probably a good value. Well, Ned, I mean, you provide incredible color. And before we get to just maybe 2 minutes of a quick market thing, which you want to flip the tables on me and ask me, what, I think for people that haven't been to Augusta, I've been there. There's something about it. It's almost like the Field of Dreams for people in baseball. What is it? How would you categorize kind of being around that place that makes it so special?
Well, it's a family reunion in a way. Every year you come, and if you're lucky enough, you get to see the same people, and maybe you only see them once a year. But to me, that the fabric of this place stitches together people in generations. And can tell my story on this. I grew up in Atlanta, and my dad and I would come down when I was a kid, and his favorite place to go, walk down the hill, holes 15 and 16. We would sit there. He'd get a cold beverage, and we'd get some sandwiches, and we would sit there all day long and watch the players come through 15 and 16. And now fast forward all these years, and I am calling holes 15 and 16, only at the Masters. It just stitches together generations, relationships, and it's a mystical place that if you haven't been and you get a chance, whatever you have to do to get there, do it.
I know it means even more this year for you, for your father, 15 and 16. So I'll be seeing if you have the emotional moment out there. I'll be listening closely to you, Ned. So, I can't thank you enough. So, all right, we got about a minute or two here. If you want to, you and I chat from time to time about the markets in general. You probably don't want to hear my answer about it, but fire away. You got me.
My two questions are, I do listen to you. So I have been defensively postured for some time now. So what could have been a real fly apart is only a little bit of like, God, it could have been more defensive, but why is gold going down? And then overall, how much farther can this thing go down? Is there, is it
the market?
Really, yeah. Do we think that the market can really have this just complete washout situation?
Let me just, yes, on the second one, but let me just look, when you say gold, why is it? I mean, gold's at 3,000. I mean, so yeah, maybe gold got a little bit over its skis over 3,100 near term. And with the tariff stuff and stuff going on, I think retail took some money off the table, but I think that's a buying opportunity. You and I have been talking about gold since it was under 2,000. So I wouldn't run from that. As a matter of fact, I actually think it's the one asset class that could outperform given all the chaos that's going on. As far as the market goes, I think we're going to reprice, even if we get through, and we have to get through the tariff stuff or else you're trading literally the end of the world. The one thing I'm watching, Ned, is 10-year yields. And everyone's talking about, oh, they want to get 10-year yields down, 10-year yields down. Well, we just isolated ourselves on many levels from the rest of the world. The economic order, the world order, and who are the biggest owners of our treasuries outside of the Federal Reserve? They're Japan and China, right? And then Europe. And so we have a lot of debt to refinance in the United States. $9 trillion, by the way, is coming up this year, and our federal debt level is $37 trillion. So if you want to let your mind go and race, what is the one thing that would really hurt this market the most? And that's yields moving higher or the inability to fund ourselves. Now, I'm not saying that's going to happen, but I think we have damaged the fabric of what's it like to trade with the U.S. as a trading partner and then investors to have money in the U.S. given the current unpredictability. So you got to own quality here. You don't buy junk on dips here, to my point. You can stay with the Googles and the Metas. I think, you're okay adding those positions over a long period of time. Companies with great balance sheets, not a lot of debt. Just be really smart. Those are the screens that are being run, right now. So you know what you own. And what I don't want to see people do is you chase on days like today up to 1 o'clock and then you end up selling at the bottom. I mean, this is a washing machine, as we used to call it. So you got to be patient. You got to be smart. But Ned, I wish we could say there's a game plan here. I don't know what this plan is, but it's certainly making me nervous. And in my entire career, I got to say that I'm happy right now. I'm not managing anybody's money, and I'm not going to give financial advice here. But long gold, and at some point the market will find its footing. But I really don't think we're close to it at this point, Ned.
Ooh.
So, but you know what? You know what's great for me? There's more tickets available because, as you know, there's no cell phones in the Masters. You have to put it away before you get in. So those fund managers a lot of those will not be able to attend on Thursday and Friday during market hours because you can't look at your phone. And I've always said the reason that, you don't think about it, but the reason there's so much clapping and you hear the roars is because no one has a phone in their hand and they're clapping and no one's filming the guy, hitting a ball 4 feet from you. Why they do that? You can go watch that back on TV. That drives me crazy, by the way. That's just purist. But
any sporting event, I agree with you. And I love the practice of not having a phone. I just think, again, this place connects generations, unlike any other place on the planet, I think.
Well, I look forward to you being my eyes and ears this week, especially on 15 and 16 for a very special 4 days here. And Ned, thanks for coming on. And I think this is very helpful. And I will blame you. You blame me for my stock picks. If I don't win this week, I'm going to come back for you. So I hope to see you in Augusta if you're not too busy, wheeling and dealing with all the players and stuff.
Hey, you got to publish your pick. You got to let me know who you ended up going.
I will. I'll put it out with this episode tomorrow. So,
all right, good sir.
All right, Ned. Thanks for coming on the tape.